Real estate investing is a broad and multifaceted field that can offer significant wealth-building opportunities. It involves purchasing, owning, managing, renting, or selling properties to generate profit. Investors typically choose from several strategies, depending on their risk tolerance, investment horizon, and capital. The three most common ways people invest in real estate are through rental properties, house flipping, and real estate investment trusts, REITs. Rental properties involve purchasing residential or commercial real estate to generate a steady stream of passive income through rent payments. They can include single-family homes, multifamily units, apartment buildings, or even office spaces. Types of rental properties. Single-family homes. These are standalone homes rented to a single tenant or family. They typically require less maintenance, but also yield less income compared to larger multifamily properties. Multifamily units. These are buildings with multiple units that are rented to different tenants. Common examples are duplexes, triplexes, and apartment buildings. They offer higher income potential due to multiple streams of rent, but may require more intensive management. Commercial properties. These include office buildings, retail spaces, or industrial properties. Renting to businesses may offer longer lease terms and higher rents, but can also involve more complexity and risk. Considerations to make when investing in rental property. Location. The success of a rental property largely depends on its location. A property in a high-demand, high-rent area will generate better returns than one in a declining or underdeveloped region. Factors like local job market strength, school systems, transportation, and amenities should be considered. Cash flow. This refers to the amount of money left over after all expenses, including the mortgage, property management fees, maintenance, taxes, and insurance, are paid. Positive cash flow is critical to generating consistent income. Appreciation. Over time, property values can increase, providing capital gains when the property is sold. This is particularly important in areas with strong economic growth and low housing supply. Property management. Managing rental properties can be time-consuming, especially if you own multiple units. Hiring a property management company can help with tenant screening, collecting rent, handling maintenance requests, and legal matters, but it comes at a cost. Tenant selection and lease agreements. Carefully screening tenants and setting clear expectations through lease agreements helps minimize the risk of late payments, property damage, and legal disputes. Maintenance and repairs. Properties require ongoing maintenance, which can be costly. Having a reserve fund for repairs and upgrades, like new appliances or a new roof, is essential for long-term profitability. Tax considerations. Depreciation. Real estate investors can deduct depreciation of their property over a period of 27.5 years for residential properties, 39 years for commercial. This can significantly reduce taxable income, even if the property is appreciating in value. Tax deductions. Many expenses related to owning rental properties are tax deductible, including mortgage interest, property taxes, insurance, repairs, and property management fees. 1031 exchange. This allows investors to defer capital gains taxes by reinvesting the proceeds from the sale of one property into another similar property, provided certain conditions are met. Risks. Market fluctuations. The real estate market is cyclical, and property values can decline due to economic downturns or other factors. Vacancy rates. If tenants vacate, the investor may face periods without income while continuing to pay the mortgage and maintenance costs. Management issues. Managing tenants, addressing maintenance issues, and dealing with legal concerns can be time-consuming and stressful. 2. House flipping. House flipping involves purchasing properties, often distressed or undervalued, renovating them, and selling them at a profit. The goal is to buy low, improve the property, and sell high, capitalizing on the difference. Key elements of house flipping. Property acquisition. Finding the right property to flip is critical. Investors often look for properties that are undervalued, need significant repairs, or are being sold at a discount due to foreclosure or auction. The right location is also important. Flipping in an area with rising home prices and increasing demand can yield higher profits. Renovation. After purchasing a property, the next step is renovation. This can range from cosmetic improvements, like painting and landscaping, to more extensive repairs, such as roof replacement, plumbing, electrical, or foundation work. The goal is to make the property more attractive to potential buyers while ensuring that the cost of repairs does not exceed the potential selling price. Selling the property. Once the property is renovated, it is listed for sale. Market timing and pricing strategy are critical. A property priced too high may not sell, while one priced too low could leave money on the table. Considerations to make in house flipping. Timing and market conditions. The success of house flipping is highly dependent on the local real estate market and the investor's ability to complete the renovation on time and within budget. A property that takes too long to renovate or sells for less than expected can result in a financial loss. Financing. Flipping typically requires significant upfront capital or the ability to secure short-term financing. Many flippers use hard money loans, which are high-interest loans that are secured by the property itself. Renovation costs. Flipping requires a keen understanding of construction and renovation costs. It is essential to budget carefully for repairs and improvements and avoid over-improving the property relative to the neighborhood. Risk. Unlike rental properties, which generate income over time, house flipping is a higher risk, higher reward strategy. The investor is exposed to market volatility, construction delays, and unexpected costs. If the property does not sell quickly or for a high enough price, the investor can face significant losses. Profits and tax considerations. Profits. Profits from flipping come from the sale of the property, and ideally, the difference between the purchase price, renovation costs, and selling price is substantial enough to cover the investor's time, effort, and risk. Taxes. Profits from flipping properties are typically taxed as short-term capital gains, which means they are subject to the investor's ordinary income tax rate rather than the lower long-term capital gains rate. This can result in a higher tax burden for flippers. 3. Real estate investment trusts, REITs. Real estate investment trusts, REITs, allow individuals to invest in real estate without owning physical properties. A REIT is a company that owns, operates, or finances real estate assets and then distributes income from these properties to shareholders in the form of dividends. Types of REITs. Equity REITs. These REITs own and operate income-producing real estate, such as office buildings, shopping malls, apartments, and healthcare facilities. They earn revenue through rent from tenants. Mortgage REITs, MREITs, these REITs invest in real estate debt rather than physical properties. They provide financing for real estate by purchasing mortgages or mortgage-backed securities and earning income from the interest payments. Hybrid REITs. These REITs combine elements of both equity and mortgage REITs by owning properties and holding mortgages. Key considerations in REIT investing. Diversification. Investing in a REIT offers exposure to a wide range of real estate properties, potentially reducing the risk of any single property's poor performance. Liquidity. Unlike direct property ownership, REITs are publicly traded on stock exchanges, making them relatively liquid compared to owning physical real estate. Investors can buy and sell shares just like stocks. Income. REITs typically pay high dividends, as they are required to distribute at least 90% of their taxable income to shareholders. This makes them an attractive option for income-seeking investors. Tax benefits. REITs enjoy favorable tax treatment. They are generally not taxed at the corporate level as long as they distribute the majority of their income to shareholders. This allows them to pass more of the income onto investors. Accessibility. REITs make real estate investing accessible to smaller investors who may not have the capital to buy a property directly. Risks of REIT investing. Market volatility. Like stocks, REITs can be subject to market fluctuations based on broader economic conditions, interest rates, and sector-specific factors. Interest rates. Since many REITs rely on debt financing for their properties, changes in interest rates can affect their profitability. Rising interest rates may lead to higher borrowing costs and reduced profit margins. Sector-specific risks. REITs that focus on specific types of real estate, e.g. retail, office, or healthcare, may be more vulnerable to market changes affecting those sectors. Real estate investing offers diverse opportunities for building wealth, with rental properties, house flipping, and REITs being the three most common methods. Each strategy has its own set of benefits, risks, and tax considerations. Rental properties provide consistent cash flow and long-term appreciation potential, though they require ongoing management and maintenance. House flipping offers the opportunity for quick profits, but carries higher risk, and the need for capital and construction knowledge. REITs provide a more hands-off, liquid way to invest in real estate, but they come with exposure to market volatility and interest rate risks. Ultimately, the best real estate strategy depends on your investment goals, risk tolerance, available capital, and time commitment. By understanding each approach and carefully considering the market conditions, you can create a real estate investment portfolio that suits your financial objectives.
If you found this video helpful, be sure to hit the like button and subscribe to the channel. Until next time, this has been The Long and Short.